The thing is, and you will learn moving forward when it comes to trading, how you do one thing is how you do everything. Most people say the more capital I have, I will trade better. Probably because if you are faithful in small capital, then it goes on to say you are faithful, you will be faithful in big capital. And apart from that, it is very important that we learn this because you need to scale in trading. And sometimes it requires you to start small and grow to becoming a big account. So I'll just go straight to the point. Now, most of what I will be teaching, because the PowerPoint slides are thoughts and they are not like the direct presentation or direct, how do I put this? The PowerPoint are just bullet points, right? They help to act as a reminder when I'm teaching. But the majority of what I will be covering will be will be from what I am saying, right? So the PowerPoint acts as they help guide my focus because so we don't stay and overstay. So, but majority of what I will be teaching will be from what I'm saying. So you want to pay attention. And again, for my Netflix fans, sorry to disappoint you. If you're watching this at Netflix without putting anything down, nothing will change. To learn a consistent way of trading profitably with my small account, we will cover all that. So if your goal is to come here, screenshot my slides, and to leave, those things will not help you. They are just reminders. The main point or the main things will come from the things I am saying. Okay? So, how to trade a small account profitably? Now, we need to first of all get into why this is important. Of course, everybody knows, but to reiterate so that we pay attention. The thing is, most retail traders, they start with little or no money, especially people who are coming into the trading world for the first time. I've been trading for a while and I know this. Majority of people who start trading, they have little or no money to start. They are the small accounts are more likely to blow up. What does this mean? Statistically speaking, based on research and studies over and over again, if you have a small account from $100 to $1,000, and this is not me, right? This figure, I wish I could like do something to my mouse so that I can help with my pointers. This particular figure isn't me, right? I didn't decide this one. Let me do this and see. I didn't decide this one. This part was not me. This is based on statistics, based on data, based on results from studies, and then you can just go to your Google and punch it, you'll see it. Then go to Financial Times, you'll see it. Go to New York Times, you'll see it. If your account is between $100 to $1,000, it's a small account. Just make peace with it. Don't fight it, regardless of what the $1,000 is in your currency. For some particular currency denomination, it is more, even into the millions. And for others, it is not. But regardless, we use dollar as the benchmark. And from $100 to $1,000, you're trading a small account. Now, prop firms have used this to their advantage. Small accounts blow up. If you are trading with $50, $10, and you've seen this, especially those people that trade like from 200 below, your account tends to blow up compared to somebody who trades higher equity because these guys have more capital to play with, right? So the average income earner or the middle class or the advanced class, whichever, when they come into the trading world, and sometimes some people can be okay, well to do, right? They can have money, but still, when they want to start, they start small, which is advisable, right? The results at the end of the day is what we look for. Now, you are well aware of why we need to learn this because you will lose your account if you don't learn this. Now, first and foremost, never trade with money you cannot afford to lose. I cannot teach you any strategy to grow any account I can't teach you that if your money in that account is something you know that once you lose that, you can't pay for your wedding, or you can't feed your children, or you cannot let it go because of the importance of that account. Everything I teach you will not work. So first and foremost, we have to scratch that. This means that if you have more money you borrowed, and the person you borrowed the money from is the mob, and they will come to your house and take your feet and cut off your body parts, that that's on a lighter note. But I'm very serious. If you're taking that kind of money, don't put it in trading. Please do not put that kind of money in trading. So if there's money you cannot afford to lose, and I did that by putting four arms here, it's intentional. If everybody is fighting for the money, please do not take money that you cannot afford to lose. Please. You won't, there is nothing I will teach you. So somebody says, oh, what if I worked a salary, right? And then I earned the salary. What you should do is part of your income, there should be a part that says investment, the part that says investing in your career or investing in yourself. No matter how small you're earning, there should be a part of your investment that cuts out to say, this is the amount, right? I'm putting into my investing in myself, investing in books, investing in my trading, investing in courses or in teachings. That is the money you put in trading, not the one you have to eat from, especially if you have a small account. Now, the second thing is you should always use a strategy you have already tested and proven. If this part is set, I can show you how to grow a small account. If this part is not set, you should not be in this training, or now that you are in this training, you know that this is the part you go and fix first before we even move forward. Never trade with money you cannot afford to lose. That's one. I'm reiterating this because it's very important, because we have I have a past where there was a time it was very dark. I think it was 2020, during the COVID. I've been trading for a long time, and then had to borrow money to say I want to trade. They'd eventually pay back, but taught me a major lesson. There should be nothing, and if you're listening to me, there should be nothing that should make you borrow money to trade. There is no guarantee, none, not even the one that the mentor promises you. There is no guarantee, okay? So we always use a strategy that is proven. If you don't know a strategy that is proven, I've taught you how to test your system. Go back and watch the previous teachings, right? Now, this is where we get into the meat. We will use a case study. I hope you've been writing. Now, we will use a case study of a $200 account, okay? So everything, like I said, the slides are just guidelines. Everything I say, this is going to help me guide you through the system. So what you're going to do, first of all, depending on what account you're using, right? So I will use a $200 account. I've told you from 100 to 1,000 is small. So whichever range you're using, let's work with that. So you will carry your $200, right? And then the highest you are allowed to risk, especially when you have your A probability setup. A probability setup means all stars are aligned. When all stars are aligned, you will risk 2% of your account. Now, what does it mean when all stars are aligned? All your checklists are clicked. 2% of a $200 account is $4. $4 on a trade. Your risk to reward ratio should be higher, must be higher than 1:1 or 1:1.5. This means that you will target for every time you place a trade. And I know some of you are like, oh, why is it telling me this? Why am I not going to raise 10? This is because if you over leverage on a small account and you trade more than 2% and the market goes sideways, say you are trading 10% of your account, by the time you lose three trades in a row, which is very possible, by the way, by the time you lose three trades in a row, you enter a flight or fight mode. Then you begin to fight for that profit back. You will blow that account in one day. So what you will do is you will risk $4. Now, if your account size is so small, chances are if you're trading below $10, $20, you are going to lose the account. So what you will do is, because it's that you have a $10 account, I don't know how to say this. It's the unfortunate truth. You are going to lose a $10 account if you trade it that way. I know you have seen, oh, there is somebody online that did they did $10 to $1,000. I've seen that. It's on Instagram. How many times did they do it? But did they do it like every single week, or did you come back after 6 months and find that they did that same thing? Nah, it's only one in a million. And how do you know which one will happen for you? Okay, so this will keep, when you have more capital to play with, do what they do. I mean, it's up to you. I'm not advising that, but if you want to do that, if you have a $5 account or a $10 account or a $20 account, convert it into cents. I wish I could write with this. Convert it into cents. What do I mean? There is what we call a standard cent account, and many brokers offer that now. So your $10 will be converted in your, excuse me, okay, in your account. What you will see is 1,000 USDC. This means that the same way you trade $1,000 account that you calculate your risk 1 to 2%, you can do that here now. Now, if you convert it, I'll go back to 200. I want to, because of that question somebody raised earlier. If I have a $10 account and I convert it to 1,000 cents, listen to me. If you trade that $10 without a proven system, even if you have a proven system, the chances of you growing that thing from 10 to 100 and 100 to 1,000 is very, very minute. The odds are heavily stacked against you. And guess what? Brokers know this. That's why they let you deposit with as small as $5. You will lose it. They know what they're doing. You know what I'm talking about. So, in order for you to trade profitably, turn your $10 into 1,000 cents. If you have $20, turn your $20 into 20, or sorry, into 2,000 cents. If you have $30, we're telling you what we did that period. If you have $30, turn it into 3,000 cents. Now, if you have 50, from 50 upward, you can choose to turn it or leave it. From $100 personally, I believe from $100 upward, you can you can put it in a standard account. Okay, so if I'm speaking to you now, and what you have is a $5 or $10 or $20 or $30, turn it into cents. It will work wonders for you. Of course, it's small. Yes, you know what you're trading is small, but turn it into cents. Then when you turn it into cents, you will be risking from 1 to 2% of your account, especially 2%. So you'll be risking 2%. And mind you, everything I'm teaching based on compliance reason is for educational purposes. Uh, do well to, past performance does not guarantee future returns. So do well to backtest and test for yourself, and every trading is your responsibility. So with that said, 2% of your account is what you will risk. This is exactly how I did it. So using a $200 account, so whatever account you're using, if you're using 5, 22 cents, if you're using 10, 22 cents, 20, 22 cents. So what you will write instead of 200 is 2,000, right? Okay, so let's go back. So you're risking $4 and you are aiming for anything that is higher than 1:1.5. This means anything higher than $5 is your target. The next thing you pay attention to is your risk to reward ratio. All this is inside number one, your percentage risk per trade. What is risk to reward ratio? In the trade you are taking, right? This is where I'm going to move us to the chart briefly, then we will come back. In that particular trade that you are taking, is the market, this gap between your entry and your exit. Let me share the screen. The gap between your entry and your exit, that trade you're taking, is there space enough before the market likely turns? That will give you, this is how I get to catch long moves in the market. I hope we can all see my screen. So if I'm entering a trade, by the way, dollar was being tricky today. If I'm entering a trade from here, around this level, okay? So we have previous resistance acting as support, can call it a breaker block. I really do not care what you call it. The market returns, hits this as long as this is your entry criteria. So we have something like that. If from where you are entering, the range from your entry to where there is a potential draw on liquidity or whatever made you enter the trade, if the gap is long enough, take the trade. If it's not, don't. If the gap is wide enough, guess what this gives you? This gives you the opportunity to risk. I'm putting the stop below this fair value gap. It gives you the opportunity to risk $4 and to target what? One is to what? One is to 3 point. Okay, let's say one is to three. One is to three. No, that's one is to five. Sorry. So your $4 is targeting 20. If your account size is bigger, notice that whatever you are doing, you are targeting times four of it. It's all about where you enter and all about where your trade is going that determines the quick growth of your account. So when you see me sometimes I do I trade and one trade is having 75, 100, another trade is having 400. This is the secret. I didn't hide it. This is it. Because where I expect the market to draw to is here, and the entry and the stop loss is tight. Now, if you miss this and you are here, for example, you see that from here to here, you don't have much room. You're only doing 1:2. So this is another thing. This is one major thing that would surely help your trading. The entry to the exit. How is the gap? What is the risk to reward ratio like? If your risk reward ratio is greater than 1:3, 1:2, you have secured a good entry and you hold the trade for until price gets to that take profit. You have to learn how to not be afraid, but you want to trade a small account, this is the secret. The entry to the exit is everything. When you look at your entry and you look at your potential exit and the risk to reward ratio is greater than 1:2, you have a trade. Let me run. Now we'll continue. Is this here? Okay. Awesome. Now, the second thing is stop opening too many positions at once. I know there are people here who likes to start, right? They will say, knock and better lot size. That's what we say in Africa. We increase the lot size. Why? Because when you have a small account and you have bills to pay, you want it to work. I've done that. Been there. I stopped because in the market, when you've bought so many times, and sometimes it's good that it didn't work for me. I think about it and I'm like, wait, would I have even been this coordinated in my trading? Would my trading even make sense if those periods when I was over leveraging was working out for me? So it won't work for everybody. So stop opening 4 positions, 10 positions. How many size do you have that you are? And you see somebody with $5 or $50 or $10, you're opening too many positions. Don't do that. It won't help you. Instead, what you are allowed to do is open two positions. Like I said, don't look at the slide, listen to me. 2 positions is what you open. The first position, this is practical stuff. Every time you take a trade, right, you are risking 2% per trade, even if you are opening 2 positions. What does this mean? So I'm trading GBP USD, right? And on the GBP USD, I see a potential buy, like let's say, like for example, the one I showed you. And I'm supposed to risk 2% using a $200 account, write down your own account, or let's say using a $1,000 account or a cent account, I'm risking 2%. 2% is around 20, right? Then I would open 2 positions. Each one will carry 1% risk. Then once one gets to 1:1.5 or 1:2, I will close that one and allow the other one break even. which means immediately the trade is closed, I will break even. I will go back to the chart again. Uh, I really don't want to take time, but please just bear with me. I have to deal with this so that we are all together. So this is one trade, right? Let's assume we take another. This is trade two. This is how you will trade your small account. You will open two positions and distribute your risk. Somebody says, "Oh, I don't like risking more than." Now, if you're very conservative, go to 1% risk per trade. This is for people who put in money that they can afford to lose. If you want to grow, you must take risk, but calculated risk. Calculated risk. The calculated risk is from 1 to 2% of your account. If you're risking 0.25, you won't see growth. I'm just being honest with you. You must, that's why we started by saying put in money you can afford to lose. If you have lower, go to cents so that you can take 1 to 2%. If you cannot find a thin line between fear and risk, you won't make money. It's the truth. You will not make money. So we have two trades here. And these two trades that we have opened, one will break even halfway or when it reaches 1:2. Why? So that I always take money. That's why some of my trades, some have small wins. The other one that I let to run has more wins because I have to take something from the market. The other thing is be quick to break even, especially if trade one has hit TP. There's no need waiting for a price to come and turn and take your second trade out. All trades after trade one hits TP and you're out of the trade, break even second trade. This is real practical stuff that will test you. Write down everything I'm saying. Two trades per entry. Distribute your risks with two trades. First trade, hit takes profit. The second trade, break even. There's no need to hold the trade to come down to hit your stop loss. I don't know if what I'm saying is making sense. Let's move on. Quickly now. Okay, so this is exactly how we do it. Now, the third thing is you need to know which of your trading setups, which time you trade are the best. Your small account, you have to be picky. You have to be picky with trades. You have to choose your trades. So if you work well on the 1 minute time frame and once you see your model, you execute out of 3 trades in a day, right? You take 3 trades in a day, and two is always almost profitable. How will you know this? Journal. Oh, I need a sophisticated Excel sheet. You don't need anything. Carry a book and a pen and open that book and write 2 trades per day. This is the trade. This is how I felt. This is the account. Stop waiting for everything to be sophisticated. Make it as simple as possible. Okay. I entered by this time and this was the outcome. I waited for this. I did not wait for this. You will know your mistakes. You must journal those trades. So you will make a target. Okay, I'm not going to take more than 2 trades a day because I have noticed in my journaling, I take losses after 2 trades per day. Then you will keep your trading plan written and visible. Some of us don't have decks. Put it on your palm. Some of us have sophisticated trading decks. Pin it somewhere. Some of us have a dedicated trading room. Like me, put it in your trading room. Frame it like some people do. Okay? So I will go over the rules now so that we wrap up. First off, if you're trading small accounts, you should not be you should not be trading more than more than three assets. So we see you in gold. What are you doing around gold with a $5 account? For God's sake, like what? Ask yourself that question. You are laughing at yourself because you know it doesn't make any sense. What are you doing around gold with a $5 account? And by now, if you are not planning to turn your $5 to $30 into cents, then you shouldn't be here. You should have left since I started talking. Focus on percentage growth. This is a big one. I'm wrapping up now. So this is what we do. With a case study of $200 account, right? Risking 1 to 2%, which is $2 to $4 on a trade, right? Making sure that every time we close a trade, we are making more than $3 to $5 on every trade, right? Then when we take a trade, we will select 3 assets, GBP USD. I'm just suggesting find the one that works with your personality. I don't even know why people are trading GBP, JPY when they have a small account, but whatever works for you. AUD, USD. I'm calling some of the safest and calmest pair, right? And then say New Zealand USD or maybe New Zealand JPY, right? To diversify. Every trade I open will risk 2%, and then I will distribute my risk across this thing. The first one hits a TP of 1:1.5 or 1:2, I will close the trade. The better risk to reward ratio I can get on my trade, this means from the point of entry to the point of exit, right? There should be a gap. There should be a reasonable gap. Price should want to trade to that level. Like it should not be something too tight. You want to see a gap on your trade. This is the most practical way I can make it for you. If you have a $10 to $20 account, change it to cents. If you don't know what a cent account is, a cent account is like a dollar account, but this time it will convert your dollars to cents. So if 1 cent is equal to 100, $10 is equals to, if $1 is equals to 100 cents, $10 is equals to 1,000 cents. $50 is equals to 5,000 cents. If you have from 20 to 30 to $50, convert it into a cent account. Anything above, knock yourself out. Okay? Focus on percentage. You see how I'm doing mathematics? That's how you treat your small account. That account has the potential to grow, but not to pay your bills overnight. That's where we make it. Somebody says to me, oh, I have $20. I want to use this to be making money every week and be going out. I really cannot tell you if that would work all the time. Maybe once in a while you can't do that, but to always come out by the end of the week with something, turn it into a cent account. That would give you more edge. Okay. So, but to expect that, oh, my $20 will become $50 by the end of the week, I'll take 30. Next week, I'll do the same thing. Next week, I don't think that is feasible. Cut losses fast, especially when, and this is very hard because people don't like to lose money. So when you put money that you can afford to lose, don't let your trade stay long. Consider using a cent account to manage risks better. This was what I was looking for earlier. This will help you, right? Then think long term. Oh, this is a big one. This is a big one. When you put a small account, all right, I know you want to make money to pay your bills. I've been there. I understand what that is like, but it will not be as easy as that. So what you can do is think about what the future would be if I manage to flip this account. And that's the target also. Your goal is to first of all flip it, not to make turn $100 from to $10,000. It won't work. So take your $200 and say, I am going to risk 2% of every trade I take. I'm going to be risking $4 to $5 on every trade, $4 to $5, targeting anything from $7 to $10. And for the day where you have a risk to reward ratio that is more, the $5 will be giving you 20 to 25. You just need 4 of those good trades. You're already having $100 added to your $200. 4 of those good trades. So select the trades. How do I know the trades to pick? The one with the best risk to reward ratio. Now I know I have a lot of questions. Okay, so before we wrap up, let me hear them. If you have questions, let me hear them.